Since the start of March 2026, trillions of dollars have evaporated from the broader equities market. Yet, in the middle of this massive capital flight, three specific microcaps are experiencing violent, explosive surges, gaining 63, 96, and even 159%. As always, we are breaking down the mechanics of these trades for educational purposes, not providing personalized financial advice. To understand why these three stocks are anomalies, we first have to measure the downward macro gravity they are defying. The pressure started with the latest producer price index, which came in hotter than expected, confirming that inflation remains deeply entrenched in the supply chain. That stubborn data forced the Federal Reserve to publicly halt any expected rate cuts, heavily restricting the cheap capital that growth stocks rely on. Compounding the tight monetary policy, escalating geopolitical tensions in the Middle East, specifically surrounding Iran, have generated sudden constraints on global energy output. Those constraints have pushed crude oil prices well past $98 a barrel, creating a textbook stagflation environment, stagnant economic growth paired with rising costs. The resulting panic has been severe. We are seeing major indexes suffer massive liquidations, with the Dow plunging over 750 points in a single session. But while the megacaps bleed, TLYS, Sable Offshore, and Amprius Technologies have completely decoupled from this macroeconomic gravity. It is easy to look at a 159% gain and blindly chase the ticker. Our goal is to investigate the actual mechanics driving these surges at the micro level. Finding true alpha during a broader market crash requires deconstructing momentum into its raw components: market mechanics, geopolitics, and physical science. Otherwise, you risk stepping into a deadly value trap. We start with TLYS, the ticker TLYS. Over the course of March, shares of this youth apparel retailer exploded from under $2 to over $3.57. This graphic tracks the specific catalyst, their fourth quarter earnings report. After a long streak of losses, TLYS posted a net income of $2.9 million, their first profitable fourth quarter since 2021, driven by a 10% increase in comparable store sales. But a 10% sales bump does not organically justify a 159% stock surge. This price action is the result of a short squeeze, a forced event where traders betting against a stock must buy shares. TLYS had a low float paired with high short interest. When the surprise profit was announced, trapped short sellers had to instantly buy back shares, causing the stock to spike 81% overnight. Because this buying is mechanical rather than organic, the institutional outlook remains highly skeptical. The current analyst consensus for the stock is firmly set at hold or reduce. Average price targets currently sit between $2 and $3, well below the inflated trading levels. The underlying retail fundamentals are improving, but the massive premium is entirely mechanical. Once the forced buying stops, the squeeze fades, leaving late buyers exposed to a massive 30 to 40% downside reversion. Moving to the energy sector, Sable Offshore Corporation, ticker SOC, presents a very different decoupling mechanism, climbing 96% into the mid-teens. This operation relies on massive physical infrastructure, specifically an isolated offshore platform designed to extract crude from coastal reserves. While the company did beat recent earnings per share estimates, the actual driver of this stock's momentum is entirely regulatory. The catalyst centers on the Federal Defense Production Act, or DPA. The DPA is a federal statute that grants the president broad authority to control domestic industries in the name of national defense. Here, local California regulators previously blocked the pipeline needed to move Sable's oil. However, a federal DPA mandate bypassed those restrictions, forcing a restart. With the barrier removed, Sable is racing toward a physical target, moving 50,000 barrels of oil per day by April 2026. If they hit that flow rate while global crude remains elevated above $98 a barrel, analysts project a revenue run rate exceeding $2 billion. This creates what we call binary risk. Binary risk means the investment outcome is tied entirely to a single pass or fail event. If the physical pipes hold and the federal mandate withstands legal challenges, Sable could multiply in value. But if the pipeline is halted again, the stock collapses. It is an event-driven gamble, not a standard value play. That brings us to Amprius Technologies, ticker AMPX. At a 63% gain, it is the most fundamentally sound anomaly on our list, steadily pushing past $19 a share. Their momentum was ignited by highly bullish 2026 forward guidance, projecting revenues of at least $125 million. More importantly, they coupled that massive revenue spike with proven execution, slashing projected net losses to under $8 million. They're securing lucrative electric vehicle and aerospace contracts because they solved a critical physical limitation: energy density. Energy density measures how much power a battery can store relative to its physical weight. This graphic breaks down the chemistry. On the left is a standard graphite anode used in almost all commercial batteries. On the right is a silicon anode. Silicon is scientifically proven to hold up to 10 times the capacity of graphite. The historical problem is that when silicon absorbs that much energy, it physically swells and degrades rapidly, destroying the battery. Amprius executed a structural solution. They engineered a proprietary microscopic wire-like framework that safely contains the swelling, stabilizing the chemistry. By solving the actual physics, they unlocked entirely new commercial markets. That tangible progress is exactly what allowed the stock to decouple from the broader market fear. It is also why institutional analysts have issued a unified moderate buy consensus, repeatedly hiking price targets to between $19 and $22. Unlike a forced mechanical squeeze or a regulatory coin flip, Amprius's momentum is driven by verifiable scientific execution, making it a legitimate growth at a reasonable price investment. As we zoom back out, remember that the macroeconomic reality remains brutal. Persistent inflation and high oil prices are still draining capital from the major indexes. In an environment this hostile, the psychological urge to blindly chase the few green tickers on your screen is incredibly dangerous. As we have established, a stock going up does not automatically make it a good business. TLYS is a mechanical squeeze masking fundamental risk. Sable Offshore is a binary geopolitical event. Only Amprius represents actual technological execution. If you engage with these volatile microcaps, your first rule of risk management is non-negotiable. Mandate strict stop-loss orders and keep your position sizing extremely small. Second, let the underlying catalysts confirm the price action. Always wait for a pullback instead of falling victim to the fear of missing out after a 100% surge. If this rigorous, data-driven approach to market mechanics helps you navigate the volatility, hit the like button and subscribe to ValueVest Daily. We deconstruct the fundamentals so you can protect your capital. The stagflation sell-off is far from over. Drop the specific high-risk tickers you want us to tear apart next in the comments below, and we will see you in the next breakdown.